The week ending May 16, 2025, marked a dramatic turning point for gold traders across the globe. In a market already on edge from months of volatility, this week stood out for its intensity and the sheer speed of price movements. Gold, long considered a safe haven in times of uncertainty, was suddenly thrust into the spotlight as traders scrambled to make sense of the unfolding chaos. Gold, ZAR-USD, had plunged nearly 11% from its recent peak, sending shockwaves through the market. Yet just as quickly, it rebounded sharply from a multi-week low, finding support at a level many analysts had been watching closely. This dramatic reversal left both seasoned professionals and new investors questioning what would come next. The sudden shift set up a tense standoff. Was this rapid sell-off simply a healthy correction after months of gains, or was it the first sign of a much deeper decline? The debate raged on trading floors and in online forums, with opinions split and uncertainty running high. The market's first major test came in the wake of a significant geopolitical event that rattled investor confidence. Headlines flashed across screens, shifting sentiment in an instant and forcing gold to compete with a renewed appetite for risk in global markets. Suddenly, the safe haven status of gold was being challenged as traders weighed new opportunities and threats. For many, the May 16th price chart became a battlefield, with clear support and resistance lines marking the territory for bulls and bears alike. Every tick of the chart was scrutinized, as traders tried to anticipate the next big move and position themselves accordingly. The outcome of this standoff would set the tone for the weeks ahead, making this moment a focal point for both strategy and risk management. Teams gathered to reassess their positions, weighing the risks of holding on versus the potential rewards of acting decisively. Bulls clung to the long-term uptrend, pointing to gold's resilience over the past year and its reputation as a store of value. Meanwhile, bears highlighted the year's largest weekly drop, arguing that the tide might finally be turning against gold after an extended rally. The big question on everyone's mind: should you buy the dip, taking advantage of lower prices, or brace for more downside as the market digests new risks? The uncertainty was palpable, with traders hesitating over buy and sell buttons, knowing that a single decision could make or break their month. As we explore this pivotal week, we'll break down the key news events, technical levels, and trading strategies that shape the gold market's direction. From sudden news flashes to intricate chart patterns, every detail played a role in the unfolding drama. The lessons from mid-May 2025 serve as a powerful reminder of just how quickly market tides can turn, and why staying informed, adaptable, and disciplined is essential for anyone navigating the world of gold trading. In early May 2025, gold prices experienced a dramatic and sudden drop, sending shockwaves through the commodities market. This sharp decline wasn't just a random fluctuation, it was triggered by a significant geopolitical development that caught many investors off guard. The catalyst? A long-awaited truce in the ongoing US-China trade dispute, which had dominated headlines and fueled market anxiety for months. The announcement of a 90-day tariff reduction deal between the world's two largest economies sparked a wave of optimism. Investors, who had been seeking safety in gold amid trade tensions, suddenly shifted their focus. They poured capital into equities, betting on renewed global growth and improved corporate earnings. Gold, which typically thrives during periods of uncertainty and fear, quickly lost its appeal. As the immediate threat of escalating tariffs faded, so did the urgency to hold on to safe haven assets. At the same time, the US dollar surged in response to the positive news. A stronger dollar made gold more expensive for international buyers, further accelerating the sell-off as traders rushed to adjust their positions. The market, which had been steadily climbing on the back of safe haven demand, reversed course almost instantly. Traders scrambled to reevaluate their strategies, leading to heightened volatility and rapid price swings. With the threat of a full-blown trade war temporarily off the table, one of gold's key supports vanished overnight. This triggered a cascade of selling as both institutional and retail investors rushed to exit their positions. While global stock markets soared to new highs, gold was left consolidating its losses, struggling with lasting agreement. Uncertainty still lingered in the background, keeping some investors on edge. Gold entered a state of limbo, caught between the relief of de-escalation and the unresolved risks that could resurface at any moment. This uncertain environment set the stage for a technical battle in the gold market, as traders and analysts closely watched every move, searching for clues that would define the weeks ahead. After the trade truce, technical analysis took center stage for gold traders. The market was boxed in, major support at 31.32 to 31.37, and resistance at 32.65 to 32.88. These levels were backed by key technical indicators: Fibonacci retracements, price extensions, and pitchfork channels. The rebound from support showed buyers were defending their ground. Bulls needed a decisive break above resistance to regain control. Until then, sellers had the upper hand. If support failed, bears eyed 31.21 and 30.80 as next targets. A break above resistance would open the path to 33.55 and beyond. These levels gave traders a clear roadmap for managing risk and setting targets. The market's next big move would be decided at these boundaries. For bulls, everything hinged on defending the 31.32 to 31.37 support zone. Holding this level would confirm the sell-off was just a correction in a larger uptrend. The first step break above 32.65 to 32.88 resistance. A breakout here would trigger stop losses for shorts and signal bullish momentum. Next, bulls would target the 33.55 to 33.81 zone. Clearing it would confirm the broader bull market's return. The ultimate goal: retest the record high at 34.31. Achieving this would require not just technical strength but a new bullish catalyst, perhaps renewed geopolitical tensions or a weaker dollar. Bulls watched for any sign the risk-on narrative was fading. The path higher was clear, but far from guaranteed. Bears had a straightforward plan: break the key support at 31.32 to 31.37. A decisive move below would signal the rebound was over and a deeper correction was underway. This would likely trigger forced selling, accelerating the decline. Bears targeted 30.80, then 30.18, with a major support zone at 29.53 to 29.56 as the ultimate prize. Fundamentally, bears bet on the trade truce holding and global growth improving, strengthening the dollar. Any hawkish central bank signals would add fuel to the bearish case. For bears, technical breakdown and positive economic news had to align for a sustained move lower. While bulls and bears waited on the sidelines, uncertain about the next big move, gold's sideways action in late May created a prime setup for range trading. A strategy that thrives when prices are locked in a tight band, moving neither strongly up nor down. Range traders seized the opportunity, capitalizing on the predictable swings between well-defined support and resistance levels. Each bounce within the range became a calculated chance to profit. Instead of chasing the hope of a breakout, they focused on the reliability of the range, ignoring false alarms and sticking to their plan. The core tactic was simple: sell near resistance, between 3,300 and 3,307, where sellers typically stepped in to push prices lower, and buy near support, between 3,281 and 3,289, where buyers reliably defended the lower boundary. To manage risk, tight stop losses were placed just outside the range, ensuring that a sudden breakout wouldn't wipe out profits from multiple successful trades. Success depended on the market staying contained. If momentum started to build or volume spiked, it was a warning sign that the range could soon break. In those moments, range traders had to adapt quickly, sometimes exiting positions in seconds to avoid losses. During these periods, fundamentals and news events took a back seat. Traders paid little attention to headlines, focusing almost exclusively on price action and technical signals. Short-term price action was all that mattered, with many traders glued to 1-minute or 5-minute charts searching for the next entry or exit. But every range eventually breaks, sometimes with little warning, so vigilance and quick reflexes were essential to avoid getting caught on the wrong side of a sudden move. For those who mastered the art, range trading offered quick, repeatable gains, often in a matter of minutes or hours. But it demanded discipline, patience, and the readiness to switch strategies the moment the market's character changed. In the end, the market's indecision became a playground for nimble traders, until the inevitable breakout arrived, changing the game once again. Savvy traders in mid-May watched not just charts but also market sentiment, especially hedge fund positioning. The Commitment of Traders report showed only limited selling after gold's drop, suggesting no panic among big speculators. Net long positions were already at a 14-month low, meaning there wasn't a crowded long trade to unwind. This reduced the risk of a massive forced sell-off, but also meant a new bearish catalyst would be needed for further declines. Conversely, light positioning could spark a sharp rebound if positive news hit. The market was hesitant, not panicked, mirroring the price consolidation. Speculators were in wait-and-see mode, coiled for the next move. Whichever way gold broke, sentiment would determine if the move had staying power. Positioning data added another layer to the complex trading environment. In late May, the gold futures contract rollover from June to August became a key event. As the June contract neared expiration, volume and liquidity shifted to August, making analysis of the old contract unreliable. For technical traders, switching to the active contract was essential for accurate signals. Even CFD traders felt the effects, as price discrepancies and volatility could spill over. Understanding rollover mechanics helped explain odd price moves and kept analysis relevant. Staying on top of contract cycles was a must for serious gold traders. The events of May 16, 2025 highlighted the gold market's complexity and risk. Traders faced a tug-of-war between fundamentals and technicals, with clear support and resistance levels defining the next move. The strategy: wait for a confirmed breakout, then act decisively. Trading gold, especially with leverage, carries significant risk. Volatility is the norm, not the exception. Most retail traders lose money in leveraged gold trading, underscoring the need for discipline and robust risk management. Success comes from reacting to the present, not predicting the future. Patience and quick loss cutting are essential. Gold trading can be rewarding, but it's only for those who fully understand and accept the risks. Analysis by Golden Witch.